We had the inflation report for the month of April come out on 15th of May 2024 in the US, and it showed that core inflation has now fallen to its lowest level in last 3 years. And slowing inflation immediately gave rise to speculations on Wall Street that this will finally provide an opportunity to the Fed to start cutting rates. And rate cuts have always been interpreted to be very, very bullish for stock market by the Wall Street. And predictably enough, we saw strong rallies both in the US as well as in India right through last week. But ladies and gentlemen, that's a completely wrong interpretation, and history is very clear on that. Inflation typically starts to come down towards the end of a business cycle, and the Fed has to start rate cuts in response to that, not because the Fed wants to provide support to the Wall Street and equity markets, but because by then the economy is in such a bad state and the demand slowdown is in such an advanced state that the Fed has no option but to cut rates in the hope that rate cuts will hopefully be able to salvage the economy and prevent the economy from slipping into a recession. But guess what? The Fed has never been successful in this, and history shows us that whenever the Fed has started to cut Fed funds rate, it's just a matter of time before the US economy slips into the next recession. And that typically happens within a matter of just a few months from the point when the Fed starts to cut Fed funds rate. And hence, ladies and gentlemen, if we get an equity market rally as and when the Fed starts to cut rates, such a rally is bound to be short-lived and in fact should be used to gradually get out of equity markets. Ladies and gentlemen, once again, I cannot start this video without thanking each and every one of you for the kind of love and support that you all have shown to all my recent videos. In fact, this particular video, which I had shared just about a month back, in which I had discussed the possibility of a liquidity crisis that can potentially manifest itself sometime later in 2024, has managed to do exceptionally well. As you can see, this particular video over the last 1 month has managed to garner more than 1.5 lakh views. And thanks to this one video, the number of those of you who have been gracious enough to subscribe to my channel has grown over the last 3 weeks from under 5,000 to the current subscriber base of over 11,000 subscribers. So ladies and gentlemen, thank you once again for this overwhelming show of love and support to this particular video. As I keep repeating, my journey as a content creator has not been a particularly long one. I have been posting videos for just about 7 months now, and during these 7 months, I have posted only 17 videos. But ladies and gentlemen, there has been one singular focus, one clear purpose behind creating each of those 17 videos. And that is to take up complex concepts from the world of finance and break it down for you in very, very simple language, so that even those of you who are not necessarily from a finance background are able to grasp those concepts, and more importantly, you are able to apply those concepts to your personal investment. And when I go through the comments that many of you leave behind after watching my videos, I do get a sense that I'm probably being able to make some headway with respect to realizing this core purpose with which I started my channel. So ladies and gentlemen, I once again reiterate my promise that I'll continue to take up ever more complex topics and concepts from the world of finance, and I'll try to break it up for you in as simple language as possible so that each and every one of you is able to grasp these complex concepts and are able to apply these concepts to your personal investments. Once again, thank you very much for all the love and support that you have shown to my recent videos. I can only hope and pray that you will continue to shower my future videos as well with the same kind of love and support. Now let's get on with what I wanted to discuss in this particular video. What you see on the screen right now is the thumbnail of a video that I had shared on 6th of April this year. That's about 1.5 months back. In this particular video, I had basically shared a framework that can potentially help you navigate this ongoing rally in the Nifty, almost up to the point when the Nifty makes its eventual top for this current cycle. And this framework is also likely to help you get out of the market sufficiently in advance before a material correction kicks in. So what is it that I had proposed as part of this framework? My proposition was fairly simple. What I had proposed as part of this framework is that one should continue to remain fully invested in one's equity portfolio until 3 conditions have been fully met. And what were these 3 conditions? The first condition was that the balance in the reverse repo facility should have gone down to 0. Second condition, the Fed should have started to cut Fed funds rate. And third condition, the yield curve should have uninverted. So until all these three conditions have been fully met, my proposition was that one should remain fully invested in one's equity portfolio, and only after all these three conditions have been fully met should one plan to gradually move out of one's equity portfolio. I'd also promised in this video that I will continue to provide updates on how these three parameters are shaping up from time to time. In this particular video, what I'm going to do is to focus on the second condition. How is the Fed funds rate shaping up? Because this is one condition around which we have seen very significant developments in the week that just went by. So the most important development that happened in the week that just went by was the release of the CPI report, the inflation report in the US for the month of April. And this report showed that inflation is now decisively coming under control. Inflation levels, prices rose by just 0.3% month on month between March and April of 2024. More importantly, core inflation came down very significantly. What is core inflation? Usually, while looking at inflation, most economists try to look at inflation after stripping off the impact of two components, food and energy, because prices of these two components tend to be very, very volatile, and hence many economists like to look at inflation after isolating the impact of these two volatile components. And when you look at core inflation levels, that came in at just 3.6% year on year. That's the lowest level of core inflation since April of 2021. And just as this report was released, Wall Street was filled with speculation that now that inflation is finally starting to come under control, Fed will have the opportunity to start cutting Fed funds rate. And that is usually considered to be very, very bullish factor for equity markets, because once the Fed starts to cut Fed funds rate, that usually has the effect of almost EMIs on every kind of loans in the US, be it home loans, car loans, business loans. EMIs on all these loans starts to come down, and hence as soon as the CPI report was released, we saw very strong rallies both in US markets as well as in Indian markets. In fact, in US markets, we had seen some pullback during the course of April. US markets had corrected by almost 5.5% during the course of April. Thanks to the rally that was witnessed through last week, this entire correction has now been fully recovered in the US. Indian markets also witnessed about 3.5% correction during the course of April. Indian markets have not fully recovered this entire correction, but Indian markets are, Nifty is just about 1% below its most recent peak. What exactly is happening here? Does inflation level starting to come down automatically mean that the Fed will be able to start cutting the Fed funds rate? And even if the Fed is able to start cutting Fed funds rate, does that automatically kickstart a bull run in equity markets? Well, I had done a dedicated video on Fed funds rate some time back. I'm going to leave a link to that video in the description section. If you haven't seen that video, I would strongly urge you to go and have a look at that video. But for those of you who are joining this discussion only now and haven't had the chance to go through my last video on Fed funds rate, I'm going to quickly summarize what I had covered in that video very, very quickly right now. And then I'm going to do a deep dive on what are the likely implications for equity markets as and when the Fed actually starts to cut Fed funds rate. But first, the basics. What is the Fed and what is the Fed funds rate? Well, the Fed stands for the Federal Reserve Bank of the US. The Fed is the central bank of the United States. Like here in India, we have the Reserve Bank of India, the RBI, acting as our central bank. In the US, they have the Federal Reserve Bank, or the Fed in short, which acts as their central bank. And the primary function of the Federal Reserve is to set the level of interest rate for the US economy, and it does so by setting the level of what is called the Fed funds rate, or the FFR in short. This is how Fed funds rate has moved over the last 20 years. What are the implications of the Fed hiking Fed funds rate and Fed cutting Fed funds rate? Usually when the Fed hikes Fed funds rate, that has the effect of interest rate on home loans, car loans, business loans, and practically every category of loans in the US to go up. And vice versa, when the Fed is cutting Fed funds rate, that has the effect of interest rate on home loans, car loans, business loans, and practically every category of loans in the US to go down. As we can see here, from November 2004 onwards, the Fed started to hike Fed funds rate, and Fed kept on hiking rates all the way till June of 2006. And in June of 2006, Fed funds rate finally peaked, and it stayed at the same level all the way till September of 2007. And from September 2007 onwards, the Fed actually started to cut the Fed funds rate. And we can see that as soon as the Fed started to cut Fed funds rate, that paved the way for the US economy to slip into the next recession, which started very soon thereafter from January 2008 onwards. And we can see that as the US economy slipped into a recession, the Fed had to cut Fed funds rate very, very aggressively. In fact, Fed funds rate came down practically to zero in a very short period of time. But why is it that the Fed has to cut Fed funds rate so aggressively during times of a recession? Well, the Fed has to cut Fed funds rate during times of a recession in order to stimulate demand. And it can do so only by cutting the cost of capital, cutting the cost of money for consumers and businesses. And it does so by cutting the Fed funds rate. Because as I just explained, when the Fed cuts the Fed funds rate, that has the effect of interest rate on business loans, home loans, car loans, and practically every category of loans in the US to gradually come down. What the Fed is basically trying to do by cutting Fed funds rate during times of recession is to cut the interest rate applicable on these loans, and in the process encourage consumers and businesses to go out and maybe take out a cheap home loan and buy a house with that, take out a cheap car loan and buy a car with that, take out a cheap business loan and maybe set up a factory with that. Because when these things happen, that creates economic activity, and this economic activity is what finally helps the economy come out of a recession. And that's why we can see that Fed not only brought the Fed funds rate down to zero, it kept Fed funds rate close to zero all the way till late 2015. And so only from late 2015 onwards that we can once again see that the Fed started to hike Fed funds rate once again. But why is it that the Fed had to start hiking Fed funds rate from late 2015 onwards? It is so because from late 2015 onwards, as a result of rates being kept so low for such a long period of time, the US economy started to show signs of an economic revival. And once the economy started to show signs of economic revival, the Fed had to start hiking Fed funds rate. But why is it that the Fed has to hike interest rates once there are signs that the US economy is reviving? Why can't the Fed continue to keep interest rates at zero even after an economic revival starts to take hold? Well, that's because once an economic revival starts to take hold, people start to get back the jobs that they had lost back during the time of a recession. And as people start to get back to their jobs, their spending power increases. And when people's spending power increases, in this backdrop, if you continue to keep interest rates very low, that would only encourage people to take out these cheap loans and buy more and more number of houses and cars and other goods and services using these cheap loans. And that can lead to an explosion in demand. Demand can go up at a very rapid pace within a short period of time. But supply of goods and services cannot go up very, very quickly. And if there is a mismatch between demand and supply, then prices can very quickly start to spiral out of control. In short, you can get inflation if rates are kept very, very low, even after an economic revival starts to take hold. And that's why the Fed has to start hiking Fed funds rate once an economic revival starts to take hold, in order to ensure that demand doesn't spiral out of control and demand only increases in an orderly fashion. But there's a flip side of Fed starting to hike Fed funds rate once again, because as I just explained, once the Fed starts to hike Fed funds rate, that has the effect of interest rate on home loans, car loans, business loans, and every other category of loans to go up once again. And as interest rates on these loans start to go up, consumers and businesses have to contend with higher interest expenses, which means that their EMI outgo every month starts to go up. They have to face the full brunt of these interest rate hikes. And as the Fed continues to hike interest rates, ultimately interest rates get to a point where they start to dent demand. Once the Fed can notice that there is a demand slowdown setting in the economy, the Fed is forced to stop rate hikes. But usually by the time the Fed notices that a demand slowdown is setting in the economy and the Fed stops rate hikes, by that time the damage is done. Because by this time, interest rates are usually unviably high for most consumers and businesses. So typically, this is the time when you would see a big spike in businesses filing for bankruptcies. You will have a big spike in ever more number of consumers reporting delinquencies on credit card loans. So the Fed very quickly realizes that stopping rate hikes is not going to be sufficient to reverse the slowdown in demand, and more needs to be done. And that's when the Fed is forced to initiate rate cuts. But as I said, by this time, the damage has been done and the slowdown in demand is irreversible. And as we can see, once the Fed starts to cut Fed funds rate, it's just a matter of time that the US economy slips into the next recession anyways. And typically the US economy would slip into a recession within a matter of months from the point when the Fed starts cutting Fed funds rate. And once the US economy goes into a recession, we see that Fed has no option but to cut Fed funds rate very, very aggressively during such times. Once the economy slips into a recession, Fed funds rate typically drop to zero very, very quickly. And it's not just the story of last two business cycles. You can go as far back in history as you want, and it's been the same story all the way back till 1954. As you can see in this chart, I have plotted these vertical pink lines. These vertical pink lines represents the periods in the last 75 years when the US economy witnessed recessions. And in case of every recession, we can see that the Fed started to cut Fed funds rate, and it was followed by a recession. In the cycle prior to that, the Fed started to cut Fed funds rate here, and that was followed by a recession. In the cycle prior to that, the Fed started to cut Fed funds rate here, and that was followed by a recession. So in case of every recession in history, we have had the Fed starting to cut Fed funds rate, and that has been followed by a recession very soon thereafter. So ladies and gentlemen, the history is very clear. Once the Fed starts to cut Fed funds rate, that is nothing to cheer about, because that only means that the US economy is going to slip into the next recession within a very, very short period of time. And what is the impact of the Fed starting to cut Fed funds rate on the stock market, especially stock market here in India? Well, to understand the impact of Fed starting to cut Fed funds rate on the Nifty, we need to overlay the chart of the Nifty on this chart. And well, that's exactly what I've done here. The blue line that you see here plots the Nifty over the last 20 years. And as you can see, once the Fed started to cut Fed funds rate back in September of 2007, we saw that that was followed by a recession in the US starting January of 2008. And just as the US economy was hit with the recession starting January of 2008, we got a very large stock market correction, not just in the US, we also got a painfully large 60% correction here in the Nifty. The same thing happened in August of 2019. This is when the Fed started to cut Fed funds rate for the second time in this century. And just as the Fed started to cut Fed funds rate, once again we see that from January 2020 onwards, the US economy slipped into a recession. Of course, this time around, the US the descent into a recession was accelerated because of the onset of the COVID pandemic. Nevertheless, because of the recession, we got a very large stock market correction in the US, and we got a very large stock market correction, almost a 40% correction here in the Nifty as well. So, ladies and gentlemen, it's very, very clear. Once the Fed starts to cut Fed funds rate, there is nothing to cheer about that. Because once the Fed starts to cut Fed funds rate, it usually means that bad things are going to follow both for the economy as well as for the equity markets. But why are we talking about the ill effects of Fed starting to cut Fed funds rate right now? We are doing that because Fed funds rate has peaked for the third time in this century. And just as Fed funds rate has peaked for this cycle, we can see headlines like these. Unemployment rate has now climbed to a 2-year high in the US. If you want to look at the exact data, this is how unemployment rate has shaped up in the US over the last 2 years. We can see that in early 2023, unemployment rate was about just 3.4%. And as we speak, unemployment in US has now climbed to almost 3.9%. This is US unemployment is now very, very close to the psychologically important 4% level. there are other signs of stress as well. This chart shows us the rate of delinquencies on US credit card loans. And as you can see, rate of delinquencies on US credit card loans reported by US consumers has gone up very, very significantly. In fact, the rate of delinquencies on credit card loans today is at a level which is significantly higher than the level that was witnessed back during the height of the COVID pandemic. So all these are signs that there is stress building up in the US economy. And if this trend continues, at some point in time, the Fed will be forced to cut Fed funds rate. And the Fed will be forced to cut Fed funds rate, not because the Fed wants to support the Wall Street or the equity markets. The Fed will be forced to cut Fed funds rate because that will be the last chance, last hope for the Fed to salvage the economy and prevent the economy from slipping into a recession. And yet history shows us that the chances that the Fed would be successful in this are very, very slim, because historically, whenever the Fed has started to cut Fed funds rate, the US economy has slipped into a recession anyways within a matter of months from the point when the Fed starts to cut Fed funds rate. Now coming to the next and the most important question. What is it that we should do with our investment portfolio in the light of all this? Now that we know that the US economy is very likely heading into a recession, and as and when we get an onset of a recession, that is also likely to be accompanied by a very large stock market correction, not just in the US, but pretty much around the world, including here in India. Should we then sell all our equity holdings in our investment portfolio and move to a very, very defensive posture? Well, ladies and gentlemen, as I have stressed many, many times in my previous videos, the unequivocal answer is no. Because what you need to understand is that ultimately equity markets will follow the economy. Once we get an onset of the recession, equity markets will tank. But that doesn't necessarily mean that equity markets will move in tandem with the economy even in the run-up to the recession. In fact, in reality, it's quite the opposite. Historically, it's been seen that in the run-up to a recession, equity markets tend to do very, very well. So clearly, there's a big disconnect between how the economy shapes up in the run-up to a recession and how the stock markets shape up in the run-up to a recession. And that's why we need to have a very clearly defined strategy based on which we can decide how long to stay invested in equity markets and at what stage we should start to get out of equity markets. And if you have to design a strategy like that, we need to first go back and study how equity markets have typically behaved in the run-up to the onset of a recession. And if you study that, what you will find is that equity markets tend to be very, very bullish in the run-up to a recession. Especially equity markets tend to be very bullish around the time the Fed starts cutting Fed funds rate. In fact, once the Fed actually starts to cut Fed funds rate, there is an acceleration in the rally in equity markets, because as I just explained a while back, whenever the Fed starts to cut Fed funds rate, Wall Street invariably interprets rate cuts to be very, very bullish for markets. So for example, the Fed started to cut Fed funds rate from September 2007 onwards. And as soon as the Fed started to cut Fed funds rate, that led to a remarkable acceleration in the ongoing rally. Over the next 4 months, the Nifty rallied a staggering 45% rally in just 4 months. But while this rally was very furious, it was a very short-lived rally. Within just 4 months, we had the onset of the recession in the US from January 2008 onwards. And as soon as we got the onset of the recession, the equity market rally very, very quickly fizzled out. And we saw a very large stock market correction, as we saw a little while back. Something very similar happened after August of 2019, which is when the Fed started to cut Fed funds rate for the second time in this century. And as soon as the Fed started to cut Fed funds rate, we once again saw a rally kick in the Nifty over the next 5 months. Over the next 5 months, Nifty rallied 13% over a 5-month period. Of course, the scale of the rally this time round was much smaller than the scale of the rally that was witnessed after September 2007. But that, in my opinion, was because of the abrupt onset of the COVID pandemic, which in my view cut short this rally. Had it not been for the COVID pandemic, I believe the rally in 2019 also would have gone on for much longer, and the scale of the rally would have ended up being something comparable to the scale of the rally that was witnessed back in 2007. But nevertheless, the broader message continues to remain the same. Once the Fed starts to cut Fed funds rate, Wall Street invariably interprets any instance of rate cuts to be bullish for equity markets, and that leads to a marked acceleration in the ongoing rally. But history shows us that any such rally always tends to be very, very short-lived. So in the light of this, what is it that we should do with our equity portfolio at this point in time? Well, at this point in time, the Fed has not even started to cut Fed funds rate. And at this stage, what we should do with our equity portfolio is something that I have already recommended in this previous video of mine, which I had published on 6th of April this year. In this, I had basically proposed a three-pronged framework. As part of this framework, I had basically recommended that one should continue to remain fully invested in one's equity portfolio until three conditions have been fully met. And one of those three conditions was that you should remain fully invested in your equity portfolio till the Fed starts to cut Fed funds rate. At this stage, the Fed has not started to cut Fed funds rate. So at this stage, there is no question of exiting your equity portfolio. At this stage, you should continue to remain fully invested in your equity portfolio. But we do need a strategy to plan our exit from the equity markets as and when the Fed actually starts to cut Fed funds rate. Because as we saw, once the Fed starts to cut Fed funds rate, and if the historical precedence holds up, and after that, we are likely to see an acceleration in the ongoing rally. But this is likely to be the last leg of the rally. While this last leg of the rally is likely to be very furious, this last leg of the rally will most likely be very, very short-lived and will ultimately fizzle out with the onset of a recession. And that's why we need to use this last leg of the rally to plan our exit from the equity markets. How exactly are we going to plan our exit from the equity markets during this last leg of the rally? Well, that requires a separate video, and that's something that I'm going to discuss in a future video once the Fed actually has started to cut Fed funds rate. Ladies and gentlemen, this brings me to the end of this video. But before I conclude this video, I do wish to address this point that has been raised by a number of my viewers as part of the comments that they leave behind after watching my videos. A number of you tend to believe that I am probably trying to sell fear through my videos on this YouTube channel. And I'm probably trying to do that for the purpose of gaining viewership. Now, ladies and gentlemen, I do agree with the point that nothing sells better than fear on YouTube. It's very, very common to sell fear on YouTube, to present a very, very bearish thesis, and in the process gain a very large viewership in the process. Ladies and gentlemen, you also need to understand that apart from being a content creator, I am also a professional wealth manager. I manage my own family's wealth and that of my clients. And nobody in the history of wealth management business ever made money by being perpetually bearish. And that's why, ladies and gentlemen, while you would have seen in not just this video, but almost all my previous videos, that while I have been quite bearish in my thesis with respect to how the US economy is shaping up, I have not been bearish with respect to the equity markets. In fact, in this video, as well as in most of my previous videos, I have repeatedly stressed that there is no case for being bearish and one should continue to remain fully invested in equity markets, at least for now. Ladies and gentlemen, I hope you will give it to me that nothing that I say here on my YouTube channel is geared towards trying to sell fear to my audience, and that too for the purpose of gaining viewership. Ladies and gentlemen, that brings me to the end of this video. I'll conclude this video here. I hope you like the insights that I shared during the course of this video. If you did like the content that I presented here, please do like and share this video, and please do also consider subscribing to this channel. Thank you very much.